In my last video, I talked about what to do if you've maxed out your TFSA and your RRSP, where I touched on you can use your non-registered account or you can use something called a taxable account. The non-registered account and the taxable account, they're literally the same. And a lot of people had concerns about what that means and what the taxable implications are on using a taxable account, or what the tax implications are on using a tax account. And so by the end of this video, I will talk you through 5 things that I wish someone had told me before I open my taxable account, just so you have an understanding of the advantages that a taxable account can give you in your investment mix, so that you are not afraid of putting your money in there and you're not just going to waste this money or spend it on something else. So let's get into it. Now, the first thing I wish I knew was reinvesting my dividends. It doesn't mean I won't pay taxes on those dividends, because initially I thought that if I don't make any withdrawals from my taxable account, at least if I don't withdraw the dividends I've earned on that account, I won't pay any taxes on it. But that wasn't true. Now, this was one of the biggest gaps, and what I figured out was the CRA doesn't really care if you withdrew from that account or if you reinvested your dividends. Your dividends and the interest earned in your taxable account, they are taxed in the year they are paid to you, not in the year you reinvest them. Whether you invest them or not, it really doesn't matter. So as long as you earn a dividend or as long as you earn an interest, you're going to pay taxes on it. But here's the part that makes things a little bit better. When I found out that, okay, whatever taxes I pay on my dividends, it's not really lost. It gets added to my cost base. What that simply means is the taxes I paid on the dividends in future years is going to be calculated as part of the cost of my assets or cost of my investment. So my starting point next year goes up. And whatever gain I make next year, that adjusted tax base would reduce whatever taxes I have to pay, because my adjusted tax base is now higher, and the gain that I'm making in a future year will be based off an adjusted tax base. So I get to pay a little bit less taxes in a subsequent time. So I don't get to pay taxes twice on the same dividend or on the same interest. All right, so think about it that way. So after the taxes on the dividends I've gone through, the other thing is there will be taxes on whatever gain that you make in your taxable account. And this is how it works. And it was the second thing I wish I knew, right? If you, let's say for instance, you buy an asset of $100 and that asset grows to $200, that means your gain is $100, right? Because you started from 100, it's now 200, you've made $100 in gain. If you don't sell, you're not going to pay taxes. That's how it works. But when you sell that investment for a profit, that investment that you bought, or that ETF or that stock that you bought at 100, if you sell it for 200, you've made a gain of 100, like I said. When you sell it for $100, only 50% of the gain is going to be taxed. Are you with me? So I can take that again. Now, let me use a different example altogether. Let's say you bought a stock on ETF for $500 and the value grew to $600. You've made $100 gain, right? When you sell that ETF, all of it for the $600, the taxes you're going to pay is not going to be taxed at the $600. No, the taxes that you're going to pay is going to be based off 50% of your $100 gain, which is half. So the rest is yours. What I've basically just explained right now is called the inclusion rate, which is a 50% inclusion rate. All right. So don't be afraid. If you've made any gains with your taxable account, you're not going to pay taxes on the 100% of the gains. No, it's just 50% of the gain that you get to pay taxes on. You see, now I wish I had known that sooner, but now that I know it, it gave me a lot more confidence to continue investing in my taxable account. And now that you know it too, you can go ahead and keep investing in taxable accounts. So on one hand, I've talked about what happens to the gain you've made in a taxable account. On the other hand, there's something that happens with the losses, because investing is a roller coaster. Some days you make gains, some days you make losses. And the third thing I wish I knew was when you have a bad year, right? The losses you make in a bad year, they're not just going to waste. You can use those losses for something and reduce your taxes. Now, I'll give you context, right? In your TFSA or in my TFSA, If the value of my TFSA goes down, there's literally nothing I can do. It's just loss of value. And that's my own price for investing, right? But in a taxable account, it works slightly differently. So think about it this way. If an investment loses money, right, and you sell it, that loss becomes yours. That loss is what we in accounting will call it a capital loss. But the good thing here is you can use that loss to reduce the gains you make in a future year. That means you can carry that loss forward and take it to a different year. I'll give you an example. You invested $1,000 in a stock, and the value of that stock drops to $800. Let's say you sell that stock at $800. What that simply means is you have made a loss of $200. That loss of $200, you can carry it forward to another tax year to reduce whatever gains you have made in that year. Let's say in this 2026, you made a loss of $200. You carry it forward to 2027. And if you have a tax bill of $300, for instance, or if you have a taxable gain of $300, you can use that $200 loss to reduce your taxable gain. Now you only have to pay taxes on $100 next year. So you see, this is a key advantage which the taxable account has that the other accounts don't really have. So if you didn't know this before, you can use this as an incentive to continue investing in a taxable account. And one thing to know with the taxable account is not all investment income is taxed the same way. And this is one of the 4 things I learned about investing in a taxable account. Because I used to think that a taxable account means everything inside just gets taxed equally. But it doesn't really work that way. So here's the breakdown. If you have interest from like a GIC or just interest income, those are taxed at your full marginal rate, the same way your paycheck is taxed. So that tax rate is going to be applied to your interest income. And the second thing is if you have Canadian dividends, that is dividends from Canadian companies, all right, you get a dividend tax credit, which helps you reduce whatever taxes you have to pay on those dividends. You remember I said that dividends in a taxable account is taxed, right? But if these are dividends from a Canadian company, your dividend tax credit applies. So it reduces whatever taxable impact is coming from there. The third thing is capital gains. So what capital gains is, the value of your investment grows. That's just a simple definition of a capital gain. You bought Amazon for $1,000 and the Amazon has grown to $1,500. Your capital gain is the $500, but that $500 is not going to be taxed 100%. 50% of that $500 is what you pay taxes on, which is you'll pay taxes on $250 out of your $500 gain. So your capital gain, only half of it is taxed, which is the inclusion rate. So what you are currently having is one account with different tax treatments. But I understand all of these tax treatments can be confusing. But the good thing is you don't have to worry about it. If you have an account with, say, Wealthsimple or Questrade or TD Direct Investing, at the end of the taxable year, they will give you your tax slip and they will do all of these calculations on your behalf. So all you just need to do, or all you need to wait for, is to get your tax slip from your brokerage account, add it to your tax filing, and you're good. You don't need to worry about all of these calculations. So it's someone else with more computing power is doing all of these things for you. Now, the fifth thing is, a lot of people think using a non-registered account or using a taxable account means you are absolutely wealthy or you have a lot of money just running out of your pocket. No. You can use this account for any reason. You can use this account for any purpose. See it this way. The tax registered account, which is your TFSA, RRSP, FHSA, they all have restrictions, right? Your TFSA, you can withdraw from it at any time, but your contribution room will only come back next year, which is a restriction. Your RRSP, you get tax deduction when you contribute, but that withdrawal from it before retirement will be treated as taxable income. Same with your FHSA. But a taxable account, you can contribute, you can invest in it, and you can withdraw it at any time. It's just a regular brokerage account. So I used to think about this non-registered account as something that day traders used to use, but that wasn't the case. Regular investors like you and I, people who have normal jobs, who do normal things and just want to invest for the future, we can also use a taxable account. So you don't have to worry so much about it, right? So you can use it after you've maxed out your TFSA RRSP, or you can use it side by side. It just depends on whatever it is you want to use it for. And that account is there for you. So you can invest in the same things you have in your TFSA, the same ETFs, just go in there, create a taxable account, buy the same thing, continue to invest. Literally nothing changes in your investment strategy. It's just the bucketing that's different. All right, guys, so that's it from me. I've given you the top 5 things that I wish someone had told me before I opened my non-registered account. I just opened that account because I didn't want to keep the money in cash. But now that I've known all of these things, and now that you know all of these things, you can continue to use that account. You can confidently open that account after you've watched this video, of course. All of these things make me an expert. I'm just someone who likes to invest, someone who likes to plan for the future. But let me know if this content you find is very helpful. Let me know in the comments if you are going to be opening a taxable account. I'm going to share my referral code to WealthSimple and to Questrade. Those are the places where I have my funds invested. So let me know in the comments what you want to see next. I read out the comments, I respond to all of them, and I'll keep making exciting and informative content for you guys, and I'll see you on the next one.